Hello to you all. My name is Sunil Bhandari and I have the pleasure of presenting to you this PQ Magazine Back to Basics video, and on this particular presentation I'm looking at the topic of business valuations. This particular presentation is supported by, accompanied by the article that was published in the latest edition of the PQ magazine. Business valuations is a topic that is tested in ACCA financial management and goes even further in ACCA advanced financial management. The article goes through, as you would expect, the basic principles of how to find the value of equity. What I'm going to do on this particular video presentation is to show you how you take the calculations presented in the article and how you actually put them into an exam situation using the ACCA's CBE practice platform. And as you can see here, I'm going to use their spreadsheet software. Before I do that, let me remind you of the lecture example, the past exam question that I'm going to use, the one that was published in the article, to remind you of the details before we go through the calculations on this particular spreadsheet. So, here is the question I'm going to use in this presentation. Like I said, this is the one that was in the article, and just to be clear, this is a past ACCA FM question which I have accordingly adapted. So the question is called close company. And let me get my highlighter just to pick up a few key points on the read through. First of all, it states that it is a stock market listed company. Now, as a stock market listed company, in this question it should already have a current share price. And when doing business valuations, if they have a current share price, a traded price, that is going to be the starting point for our valuation, a series of valuation calculations. Then we can see we've got some accounting information. We've got what is going to be their current profit after tax, which is their earnings. That will be useful for a price earnings valuation. They have dividends presented in total terms rather than per share, and that will help me for what is going to be the dividend valuation model, dividend growth model. The statement of financial position, you can see here that it's got the total assets presented. Be careful that the current liabilities are below, and then they've got what is going to be the share capital. It's important to see here that they've got $1 nominal value, 80 million. And that's always a key reading point, so you know what the number of shares in issue are. And I'm going to use that number of shares in issue on one particular valuation, the dividend valuation model. The non-current liabilities are both a bank loan and a bond. Now, quite interestingly here, I'm going to need that information along with the current liabilities when I do a net asset valuation. And because the net asset valuation, we need to ensure that we deduct all of the liabilities either at book value or NRV. What other information have I presented? The non-current assets have a realizable value of the equivalent of value for the current assets. So that's going to help me with an asset-based valuation. The analysts have got a forecast that the dividends of the company are going to grow at a rate of 4% per year. As this is a back to basics lecture on business valuations, I've not gone through the financial maths of how to go through growth rates. However, in one of my earlier presentations in the Back to Basics series, in fact in the first lecture I did on the Back to Basics series, I covered financial maths. and that looked at growth rates. It's also got future free cash flows, which have been estimated at 82 million. I have to say that the free cash flow valuation method is just about introduced in the FM paper, but is massively important in the AFM exam. Introduced at what is going to be FM, massively important at what is going to be AFM. We have a cost of equity, which I will need for the dividend valuation model, and a weighted average cost of capital, which I'm going to need for what is going to be the free cash flow model. I said at the outset that if they are a stock market listed company, we should have an initial share price, and we do. We have an ex-div share price at 8.50. The ex-div point means that the next dividend is not due until 12 months' time, and valuations of companies are based on ex-div share price. We have the industry average PE ratio at 9.25, at 9.25, and again we're going to need that for the earnings-based valuation. So that's the basic information, that's what we've got. What we're now going to do is to utilize that information, and I'll show you the presentation of the calculations using the ACCA's practice platform, CBE software, the spreadsheet. Okay, we're now ready to rock and roll on the calculations. Now I've set up a pro forma just to make it easy and efficient and effective to do this presentation. So the first calculation I want to do is to work out the current market value, all the market values initially in millions of dollars. So the current market value, I'm going to show you the full presentation I would go with here. So I've got my cell, I'll press equals, I'm going to open bracket. I'm taking the 80 million, which is the nominal value of the shares on the balance sheet. Now, I said full presentation. I'm going to divide by the nominal value per share, which you might say here, well, Sunil, 80 over 1 is 80, which you're correct. But how many times in exam questions have they given a nominal value other than $1? You know, 50 cents, 25 cents, 10 cents. In AFM, 40 cents has been a popular value. So 80 over 1 tells me the nominal value, the number of shares in issue. So the total value on the balance sheet divided by the value per share, nominal value per share, tells me the number of shares in issue. I multiply that by the current share price. The current share price is 8.50. So 8.50. I'll move that out there. Enter. And the value is at 680 million. So the current value, 680 million. Okay, let's move on to the net assets value. Now the net assets value, as per the article, is about an equation. What is that equation? And I'm going to first of all apply that equation using book values. So I've got my cell equal to, right, the equation is to take the total assets. Well, I'll put it in full, which is 595 million is the non-current assets, plus 125 million is the current assets, which I know on the balance sheet is 720, but I'm doing a full presentation. Deduct from there, open bracket, the value of the current liabilities, which is 70 million. To that, add on the non-current liabilities, which is a bank loan of 40 million, plus what is going to be the bonds at 120 million. If there were any preference shares, they would be added into the liabilities. There are no preference shares, close bracket, enter, 490 million. So repeat, that equation is total assets less total liabilities, including preference shares in liabilities. The book value, the accounting value, is 490 million. And only if you use book value. Only if you're using book value on net assets, there is a quicker way of finding that number. And that quicker way of finding that number is simply to take the issued share capital nominal value 80 million, add on to that the reserves of 410 million, and in book value that gives you 490 million. I still favour the full equation. I still favour the full equation because the full equation can be used in all circumstances. Can be used in all circumstances, so I would much prefer to go down that particular route. Having completed the net asset value in book value, we can now move on to using the net realisable value. Now, in the question, the only assets that could be changed to NRV, or I'll rephrase that, the only items that could be changed to NRV were the non-current assets and the current assets. It's assumed then that all the liabilities would be realised at their book value. I would say the bank loan would probably have a market value, but I haven't provided that in this question to keep it nice and simple. So the best way to do this on the spreadsheet is to take what we did for the book value calculation, do a copy, put it in and do a paste, and then do an edit. And the edit we want to do is on the asset valuations. So on the assets, we want to put in what is going to be 625 as the realisable value of the non-current assets, and then add on to that the 75 million for what is going to be the current assets, enter, and we've got 470 million. And it's not a surprise that the NRV is below the book value. It's not a surprise that it's gone below what is going to be that book value, mainly because of the fact that, you tend to see a lot of the assets being sold at a fire sale value. Okay, let's now move on to an earnings valuation. Now, the most commonly used earnings valuation is the price earnings method, where the company's equity is worth a multiple of what is going to be its earnings. Earnings defined as earnings attributable to the shareholders, that's the ordinary shareholders, which is profit after tax less any preference dividends. Now, I accept that in FM, there's also an earnings yield model that is used. But I wanted to make sure that this lecture was beneficial to both the FM and the AFM students. And in AFM, we don't see earnings yield valuations, we only see PE valuations. So in this simple calculation, equals, we take the latest earnings figure, 66.6 million, and then just multiply it by what is going to be the industry, in this case price earnings ratio, which was 9.25. Enter, and we get a value of 616 million. So we're saying that the assets are currently generating an earnings of, and that leads us to what is going to be a valuation of the use of those assets at 616 million. And, though in the start of my article, I said that I used the classic statement that valuations are an art, not a science. What I also ought to say here is that when you talk about practical use of valuation, the PE is a very, very practical model. So it is scientifically the one that is used a lot more on a practical basis to get to what is going to be the valuation of equity. Okay, penultimately, let's turn to what is going to be the dividend valuation model. Now, as presented in the article, the dividend valuation model is also known as the dividend growth model, and is based on the fact that a company is worth the present value of its future dividends discounted at what is going to be the current cost of equity. This model is used a lot for when you're dealing with minority interest, which is normally buying on a per share basis. So for this particular valuation, I like to start by presenting it per share. To do that, I need the current dividend. The current dividend is based on the fact that they've got 40 million as a total dividend payment spread over, we know there's 80 million shares because I've done that calculation already. There's 80 million shares, so the current dividend is 50 cents per share. Okay, now I know there is an equation for the dividend valuation model on the formula sheets, both FM and AFM, assuming that you've got a constant growth rate in perpetuity. And what we're saying here is this: we are going to take that particular dividend, we are going to multiply it by, let me open that, multiply it by, open bracket, 1, what is going to be plus, I'll get that right in a minute, plus what is going to be the growth rate, 0.04, me having fun with the keyboard there, close that off. Divide that by, open bracket, the cost of equity, which is 10%, 0.1 over decimal, minus 0.04, the growth rate. So let me repeat that. I'm taking the current dividend, multiplying by 1 plus the growth rate, dividing by 0.10 minus the growth rate, and that, in financial maths terms, is how you deal with discounting a perpetuity with growth. And if you're unsure about the financial maths, like I said before, go back to one of my earlier back to basics presentations done for PQ magazine on what is going to be financial maths. Enter, and we get a share price of 867. So we're saying the share price is 867, and on that 867, that would then mean that the value of the equity is 80 million shares multiplied by that share price, which comes out to 693 million. A point of interest: if the dividend valuation model is used to value minority interests, it's also argued that the share price on the stock market generally is when you are buying just, a few shares. You're buying shares on a per share basis. So normally, not always, normally the DVM share price and the share price quoted on the stock market would be pretty similar. And in this question, they are. The share price on the stock market is currently 850, the DVM is at 867. You would say they are materially, close to each other. So that leaves us with the final valuation, the free cash flow valuation. Now, I stated earlier in this presentation that the free cash flow valuation is just introduced in FM, but is hugely, hugely important and goes into far more detail in AFM. And again, I go back to the art, not science, but if we talk about textbook, what is the best theoretical valuation method? It would be using free cash flows. Now, in this back to basics presentation, I'm doing a basic example. I am saying the company is worth, the entity is going to be worth the present value of its future free cash flows to the company, discounted at the WACC, but then I've got to deduct the debt value to get to equity. So how do I do that? Right, so let me go into my cell and press equals, open bracket. What is the current free cash flow to what is going to be equity? And they've told us that the current free cash flow to equity is 82 million. It's assumed that that will continue forever. Next year, year after, at the same number. So if I divide that by the weighted average cost of capital and close bracket. Now whatever comes out of my calculator there or spreadsheet there, that number is the value of the equity and the debt taken together. The value of the equity and the long-term debt taken together. But I want the value of equity. So from there, I have got to deduct, well, what I should be deducting is the market value of the debt. I don't have the market value. I assume the book value of the bank loan plus what is going to be the bond, 120, book equals market. So 82 over 0.09 is the value of equity and debt taken together. Deduct from there the market value of the long-term debt, which I've assumed is the book value, and that gives me the valuation of the equity at 751 million. So now let's do a summary to close off this particular presentation. We're talking about equity valuation. The current market value, 680 million. The net asset value book, 490. The NRV, 470. The earnings valuation, 616. The dividend valuation model, close to the current market value, 693. And then what we say to be in textbook the most accurate valuation, 751 million on the free cash flow to company valuation method. Now that completes this PQ Magazine Back to Basics presentation on business valuations. I hope you found it useful. I hope you find it beneficial. Please get in touch with me if you want any further information or any further assistance. Stay safe, stay well.